One of the best things you could do as a dividend investor is to create a criteria that you will use to determine which stocks make sense for you to buy. And a criteria is basically a set of guidelines that if a stock hits all of those marks, if it checks off everything, it's something you should consider buying. And I don't say guaranteed buy because based on certain outside factors, it may not be a good fit at that moment. But if there is a stock that does not check off everything in your criteria, it's something you should probably avoid. And the reason the criteria is so important is because it allows you to really stay disciplined and focus on what you're good at instead of seeing something like take off and do really well and just like follow the herd and buy that instead of really looking at fundamentals and things that shape your criteria and what your personal goals as an investor are. So the first thing to do with setting a criteria is to think about ethics. Now, we'll be really quick here, but basically what I mean by this is if you feel like you don't believe in what the company is doing, like cigarettes, something I don't believe in at all, I will never buy any company in that area. So that's what I mean by ethics. Be clear on what you are never going to buy at all because you do not believe in what's happening in that area or is something you're strongly against. So that's the ethics piece. Then you look at some of the numbers of the company where we look at fundamentals, things like that. Once we figure out that, this is a company that I'd be happy with buying and saying that I have. So there are a few different things for a dividend investor. The first thing is the dividend growth rate. Some people, they look for a dividend stock that is growing at like 10% annually with their dividends. So for instance, if the payment is 50 cents every quarter, you're expecting at the end of the year for that to get upped to at least 55 cents per quarter, hence the dividend growth rate of around 10%. It does. Now you do have to, in a lot of cases, like when you say dividend growth rate 10%, that means you're cutting off a lot of options where some of the bigger, more established companies, it may be harder for them to raise by 10% because, for instance, it's harder for them to grow. Like, for instance, a company that has like $1 trillion cap, like your Apple or your Microsoft, it's harder for that company to double in value than it is for a company with just a $1 million cap. So for some of the bigger companies, you see the dividend growth rate, it still grows, but it may not grow at that 10% rate, which you want. So that is something to consider. The moment you set one criteria, it's going to eliminate a bunch of different options. And that's the great thing about a criteria, because then you get really clear on what makes the most sense for you. The next thing you may want to look at is what kind of a company. Like, are we looking at a growth company? Are we looking at a company that may not be growing at all, but is going to be stable? So like a bank, like I don't expect a bank to like double in value in a year or like triple in value. Or you don't expect that kind of growth, but you can expect a reliable business model with a reliable dividend that's going to keep on growing. Now, if you do look at Apple and Microsoft, which I had mentioned before, you categorize those more towards the growth. With Apple, though, a P, that's borderline value at this point. But you look at some of the growth companies, and then you say, okay, I want the appreciation of the stock just as much as I want the dividend. Because some people, they'll be happy with just receiving a high dividend with no appreciation from the stock because they need the dividend income, while someone else will say, I'll take Microsoft or Apple that'll appreciate by 20%, but may only have like a 1.5% yield. So I'll sacrifice the high yield in exchange for more appreciation for the stock. So it certainly depends on, do you care about like overall total return, where you will look for that appreciation factor, or are you more concerned about just being able to build up the dividend income in securities of companies that don't seem like they're going to grow at these high multiples, but at the same time, they're going to give you those consistent payouts, which is something that you would be looking for if that is your criteria. And we did mention Apple, Microsoft, and bank stocks. Another big part is the sectors that you're looking at. Some people like the financial sector, other people like the tech sector. Know what sectors you want to focus on. And it is okay to have multiple sectors that you focus on, but by figuring out which sectors you are okay with, you then figure out which sectors that you should avoid. And if you don't know something about a certain sector or a certain company, don't buy it. You can do research, you can learn about it, but if you don't know about it, don't buy it because you don't really know it. That's gambling. Like if you know the sector, if you know the company, you're making an educated decision based on where you're investing. But if you don't know about the company and you just see that it's going up and a lot of people are buying it, that's gambling. That is not investing. So know your stuff about the company itself and know about the sectors. Now, there are some fundamental numbers people use, like PE, price to earnings. That's something you see with a lot of the dividend companies, because dividend companies, like a lot of them, almost all of them are profitable because you got to be able to keep paying the dividend. You have to keep making money. You have to have revenue that exceeds expenses to pay the shareholders. Now, for growth companies like Shopify that don't necessarily have a dividend, let alone a PE ratio, those people use a PS ratio, price to sales, to figure out the value of those stocks. So while the PE ratio is what a lot of people use to figure out the value of the stock and to really figure out, if it's overvalued or undervalued, there are other metrics out there. One thing you may want to do is compare the PE ratio of the security you're looking at with the sector PE. So a lot of people use the SP 500. It's a really good example. It's a very good measurement of the economy, but the issue with that is it's got a whole ton of different sectors in there, which it is a good comparison for a lot of companies. But if you want to look at like a specific sector to get a better idea of whether a company is overvalued or undervalued, that is going to allow you to make a more educated decision. So when it comes to the criteria, you make sure you're using the right comps. Don't compare apples and oranges. Make sure you are comparing a stock within the financial sector with how the overall financial sector is doing to figure out whether something is over or undervalued. Being able to look at numbers also like financials of the company really matters, because sometimes a company may look undervalued from a PE ratio standpoint, but that could be because the company is on the rapid decline and isn't going to make some kind of comeback. So when you see something is undervalued, make sure you understand why it's undervalued. With TD Ameritrade, for me, that made sense because it cut off commissions, not even all of them, but pretty much most of them, which is like around 15% of their business. The stock went down 25%. The numbers there made sense for people to jump in on the dip. But it doesn't always make sense to jump in on something just because it goes down or just because it looks undervalued. So those are just some of my thoughts on creating that dividend criteria, because having that criteria in place allows you to not only get more clear on what you want, but you also get more clear on what you don't want, and you get more clear on what you do not understand. And once you buy things you don't understand because you just see they're going up, you see a lot of people are jumping in on them, you see the news is talking very favorably about these stocks, these companies, it's gambling. And with dividend investing, it's a long-term game. It's waiting for the stock to appreciate. It's having the dividend grow each year so that a stock that you buy now that may have a 2% yield, 5 years later, that same stock, that same thing you bought and you held onto it, is now giving you a 10% yield for your money or something like that, just because you kept it and that company is able to raise their dividends year over year. So those are my thoughts on the dividend criteria and setting one for yourself. I'd love to hear your thoughts in the comments if you have some kind of criteria, what you're looking at. But anyway, wrapping up this video, dream big, achieve greatness, unlock your potential today. Subscribe. See you in the next one.